Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about BICARA Therapeutics Inc. Annual Report. BICARA Therapeutics Inc. is a clinical-stage biopharmaceutical company focused on developing innovative treatments for solid tumors. At its core, the company's lead program revolves around fisrafusp alpha, a bifunctional antibody designed to target and combat cancer cells. This therapy combines two established approaches: an epidermal growth factor receptor-directed monoclonal antibody and human transforming growth factor beta. The company's primary focus is on developing therapies that can effectively treat solid tumors, which are a common type of cancer characterized by abnormal cell growth in various parts of the body. By harnessing the power of bifunctional antibodies, BICARA Therapeutics aims to provide patients with more effective treatment options and improved outcomes. BICARA Therapeutics' business primarily revolves around the development and commercialization of its lead program, fisrafusp alpha. The company's services include research and development of novel cancer therapies, clinical trials for solid tumor treatments, development of bifunctional antibodies as a treatment approach. Overall, BICARA Therapeutics Inc. is dedicated to advancing the field of oncology through innovative research and development of effective cancer treatments. BICARA Therapeutics Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. BICARA Therapeutics Inc. trades at a higher price-to-book ratio of 2.89 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 7% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through a review of the key factors that influence a company's financial performance. For revenue growth, several factors are crucial. Regulatory approval for commercial sale is a significant driver, as it enables companies to bring their products to market and generate revenue. The availability of coverage and reimbursement from third-party payers also plays a vital role in driving revenue growth. The success of clinical trials and regulatory approval process is another essential factor, as it demonstrates the efficacy and safety of a product, leading to increased demand and revenue. Commercialization of approved product candidates is also critical, as it involves the development and implementation of strategies to bring products to market and reach customers. Finally, the development and deployment of innovative approaches, such as bifunctional approaches, can drive revenue growth by offering new solutions to customers. On the other hand, several factors can lead to revenue decline. Regulatory compliance costs can be a significant burden on companies, particularly if they are not adequately prepared or if regulations change frequently. The time required to obtain regulatory approval in various jurisdictions can also impact revenue, as delays can result in lost sales and revenue. Failure or delay in obtaining regulatory approval in one country/jurisdiction can have a ripple effect, impacting other regions. Country-specific document requirements and varying regulations across regions can create complexity and increase costs for companies, leading to revenue decline. Fines, suspension, or withdrawal of regulatory approvals, product recalls, seizure of products, operating restrictions, and criminal prosecution for noncompliance with foreign regulatory requirements can also have a devastating impact on revenue. The net income of the company experienced a significant decline between 2024 and 2025, with a loss increase of 102%. This decrease was attributed to various factors, including increased commercialization expenses, operating costs, and regulatory pressures. The company also faced challenges in securing third-party coverage and reimbursement, which further contributed to the decline in net income. The profit margins were negatively impacted by rising interest rates and inflationary pressures. as well as risks associated with manufacturing processes, such as contamination, material shortages, and recalls. Additionally, smaller market opportunities than estimated, lower than expected patient population, and reduced reimbursement rates in international markets also affected profit margins. Changes in manufacturing methods and potential supply disruptions further exacerbated the decline in profit margins. The combination of these factors resulted in a significant decrease in net income and profit margins between 2024 and 2025. The company's inability to manage its commercialization expenses, operating costs, and regulatory pressures, as well as its failure to adapt to changing market conditions, contributed to this decline. The company's financial performance indicates a significant issue with its ability to generate positive operating cash flow. The data from both page 107 and page 121 reveals that the company has been consistently using more cash in its operating activities than it generates. In 2025, the net cash used in operating activities was minus $106,834,000, while in 2024 it was minus $74,751,000. These figures demonstrate a substantial decline in the company's ability to manage its cash flow effectively. The negative cash flow indicates that the company is not generating sufficient revenue to cover its operational expenses. This trend suggests that the company may be facing financial difficulties and needs to reassess its operations to improve its cash management. Without positive operating cash flow, the company may struggle to invest in growth initiatives, pay off debts, or even maintain its current level of operations. The company's financial situation has undergone some notable changes. On page 118, the total debt increased significantly from $18,121,000 to $29,542,000. This substantial rise indicates a considerable increase in the company's debt level. Furthermore, this increase is likely to result in higher interest expenses for the company. However, it is worth noting that there are no other significant changes in debt levels or interest expenses mentioned on other pages. The only other relevant information provided is on page 121, where cash and cash equivalents decreased by $393,026. This decrease in liquidity may be a concern for the company's financial stability, but it does not directly indicate any change in debt level or interest expenses. In conclusion, the most notable change in the company's financial situation is the significant increase in total debt from page 118. Management is cautiously optimistic about the company's future prospects. The company is focused on advancing its biologic therapy, Fisrafusp alpha, into late-stage clinical trials and commercialization. However, this process will come with significant expenses and operating losses in the near term. Despite these challenges, management believes that existing cash reserves will be sufficient to fund operations until 2029. Nevertheless, substantial additional capital is expected to be needed in the future to cover clinical trial costs, manufacturing and commercialization expenses, regulatory review, licensing agreements, patent maintenance, and sales and marketing efforts. Management acknowledges several key risks that could impact the company's business, including changes in laws and regulations, competition, intellectual property disputes, and cybersecurity threats. The company's ability to achieve market acceptance, coverage, reimbursement, and revenue for approved products is also uncertain. Overall, management's strategy is centered on advancing its lead product candidate while managing cash reserves and mitigating potential risks. There is no mention of acquisitions or divestitures in the provided report. The absence of any transactions related to buying or selling assets or companies leaves no notable impact on the company's financials or operations. As a result, there are no significant changes to report regarding acquisitions and divestitures. The company's financial activities have been quite active over the years. One notable aspect is its commitment to rewarding shareholders through dividend payments. As per our records, the company has indeed paid dividends, as confirmed on page 131 of our documentation. In addition to dividend payments, the company has also taken steps to return value to its shareholders through share buybacks. This strategic move is clearly outlined on multiple pages, with a detailed explanation provided on page 43. By buying back shares, the company aims to boost shareholder value and create a more stable financial foundation for future growth. There are concerns about inventory buildup. Several points highlight the risks associated with inventory management, including potential shipment delays, page 84, risk of inventory shortages, page 84, lot failures, page 84, product withdrawals or recalls, page 84. Additionally, global supply chain disruptions, page 91, could impact timely execution of clinical trials due to disruptions in access to bank deposits or lending commitments. However, the overall concern is more focused on supply chain disruption rather than inventory buildup. The potential for supply chain disruption is evident throughout the text, with risks such as manufacturing defects, page 61, delayed supply of raw materials, page 61, limited number of suppliers, page 61, and dependence on Wuzai Biologics, Hong Kong, limited for production, page 62. That concludes the financial summary for BICARA Therapeutics Inc. Feel free to comment below, and I will be happy to answer them when possible.